Most people are watching the wrong market. They're staring at stock prices, they're debating earnings, they're arguing about inflation prints and rate cuts. But the real crisis, the one that actually breaks systems, is happening in the background, quietly, mechanically, mathematically. And it starts in Japan. For more than 30 years, Japan has been the foundation of global financial leverage. Not because of its stock market, not because of its economy, but because of zero interest rates. Japan was the cheapest source of money on earth. And Wall Street built an empire on that fact. This is what's known as the yen carry trade. And if you've never heard of it, that's not an accident. Because it's been the hidden engine behind one of the biggest asset bubbles in history. Here's how it worked. Investors, hedge funds, banks, institutions, borrow Japanese yen at close to 0% interest, sometimes literally zero. They then converted that yen into US dollars. And with those dollars, they bought higher yielding assets. US Treasuries paying 4 to 5%. Stocks, tech stocks, real estate, crypto. The spread was free money. Borrow at 0, earn 5. Rinse, repeat. Leverage it 10 times, 20 times. This wasn't a small trade. This wasn't niche. This became the trade. Trillions of dollars were built on this assumption that Japan would never raise rates, that Japanese bond yields would never move, that the yen would always be weak. And for 30 years, that assumption held. Until it didn't. Japan just did something it hasn't done in 3 decades. It raised interest rates. And more importantly, Japanese bond yields exploded higher. The 30-year Japanese government bond surged toward 4%. That one move shattered the math of the carry trade. Because now borrowing yen is no longer free. Now Japanese investors can earn real yield at home. Now holding US debt no longer makes sense on a risk-adjusted basis. And when the math breaks, the trade unwinds. This is where things get dangerous. Because this isn't about Japan alone. Japan is the largest foreign holder of US Treasuries, with roughly $1.2 trillion on its balance sheet. When Japanese institutions sell treasuries to bring capital home, US yields rise. And when yields rise, asset prices fall. But that's just the surface layer. The real problem is leverage. Hedge funds didn't just do this trade once, they stacked it. They borrowed yen, bought treasuries, then used those treasuries as collateral to borrow more. 10 times leverage, 15 times, 20 times. Depending on the structure, conservative estimates suggest the notional exposure tied to this trade is between $15 and $20 trillion. Let that number sink in. That's not market cap. That's leveraged exposure that now has to be unwound. And unwinding doesn't happen gently. It happens through margin calls. When yields spike, bond prices fall. When bond prices fall, collateral values collapse. When collateral collapses, lenders demand cash immediately. So what do leveraged funds do? They don't sell what they want. They sell what they can. They liquidate anything liquid, stocks, tech stocks, crypto, commodities. Not because fundamentals changed, but because math did. This is what's known as indiscriminate selling. And it's how crashes happen without warning. Here's where most investors get blindsided. They assume bonds protect them. They assume the classic 60-40 portfolio still works. Stocks down, bonds up. Except that hedge only works when bonds are trusted. When sovereign debt becomes the problem, the hedge disappears. Stocks and bonds fall together. Correlation goes to 1. This is not theory. We've seen this movie before, and every time it plays, the same assets get crushed first. High-growth tech stocks that relied on cheap money. Companies with heavy debt loads. Speculative assets priced for perfection. Crypto, especially Bitcoin and Ethereum, because they trade like high beta liquidity instruments and risk-off events, even real estate isn't immune. As treasury yields rise, mortgage rates follow. 8% mortgages, 9% mortgages, affordability collapses, prices follow. And the contagion doesn't stop in the US European institutions hold nearly $3 trillion in US debt. At the same time, Europe is facing rising military spending, energy insecurity, and fiscal strain. If they need liquidity, they sell. This is how localized policy changes become global crises, not through headlines, through balance sheets. Now here's the most important thing to understand. This isn't a prediction based on emotion. It's not fear-mongering, it's arithmetic. When the cost of money rises, leverage dies. And when leverage dies, asset prices reprice violently. The unwind has already started. The only unknowns are speed and sequence, days, weeks, months. But once momentum flips, it feeds on itself. In the next part, we risk going to break down what this means for the average investor, why cash may not be safe, the specific market levels that signal acceleration, and how to position defensively without panicking. Because this isn't VAT about getting rich. It's about not getting poor. Now let's talk about what this actually means for you. Because macro collapses don't announce themselves politely. They don't ring a bell at the top. They don't wait for CNBC to explain what's happening. They just happen. And by the time the average investor realizes something is wrong, the damage is already locked in. The first thing that breaks in a carry trade unwind is confidence. Confidence in liquidity, confidence in diversification, confidence in the idea that someone will step in. Because when leverage starts collapsing, everyone needs dollars at the same time. And there are never enough. This is why crashes feel chaotic. Stocks fall, not because earnings collapse, but because portfolios are being liquidated to meet margin calls. Good companies get sold alongside bad ones. Winners get dumped with losers. Everything gets dragged into the same vacuum. If you're heavily exposed to growth stocks, especially tech, you are directly in the line of fire. These companies benefited the most from cheap money. Low rates justified high valuations. Debt was easy, buybacks were cheap. That era is ending. But here's where it gets more dangerous. The bond market, which is supposed to stabilize portfolios, is now part of the problem. If U.S. Treasury yields continue rising, bond prices fall. That means your safe allocation is losing value at the same time as stocks. This is how the traditional 60-40 portfolio fails. Now let's talk about cash, because this is where a lot of people make the wrong move. When markets fall, people flee to cash. And initially, that makes sense. Liquidity matters during deleveraging. But here's the trap. If this unwind becomes systemic, and the scale suggests it could, the Federal Reserve will step in, not because they want to, but because they have to. To stabilize markets, they will print liquidity injections, emergency facilities, a QE under a different name. And when that happens, cash loses purchasing power. So if you flee too aggressively into cash, you may survive the crash, only to get crushed by inflation afterward. This is why preparation is about balance, not panic. You don't want to be all in on risk, but you also don't want to be trapped entirely in depreciating currency. Now let's talk about what holds up during these periods. Historically, assets tied to real value outperform once the initial liquidation wave passes. Energy companies with real cash flow, consumer staples, businesses people need regardless of economic conditions. And most importantly, hard assets. Gold and silver don't always rally immediately during a crash. In fact, during the first phase, they can sell off. Not because they're weak, but because they're liquid. They get sold to meet margin calls. But once the forced selling ends, they tend to recover faster than almost anything else, because they are currency alternatives. This matters especially now, because unlike previous cycles, governments are already running massive deficits. Debt levels are extreme, and central banks have far less credibility than they once did. Every crisis accelerates distrust in fiat systems. This is why allocating 10 to 20% into physical gold and silver isn't about speculation. It's about insurance. It's about owning something that isn't someone else's liability, something that doesn't depend on a counterparty staying solvent. Now, let's talk timing, because people always ask, how do I know when it's really happening? There are a few key indicators to watch. First, the U.S. 10-year Treasury yield. If it pushes decisively above 4.75%, pressure intensifies. Second, the U.S. 30-year yield. A sustained move above 5% is a serious warning sign. It signals long-term confidence is breaking. Third, the USD-JPY exchange rate. If the yen strengthens rapidly, meaning USD-JPY falls below 140, it signals aggressive capital repatriation back to Japan. That's the carry trade unwinding in real time. When you see these happening together, volatility accelerates, liquidity disappears, and markets move faster than most people can react. So what's the strategy? It's not about trying to time the exact bottom. That's a fool's game. It's about positioning before the stress peaks, reducing exposure to highly leveraged sectors, avoiding companies dependent on cheap refinancing, staying away from speculative assets that rely purely on sentiment. At the same time, maintaining exposure to quality, companies with strong balance sheets, low debt, real cash flow, businesses that survive downturns. And above all, understanding this isn't a normal correction. This is a structural unwind, a repricing of leverage that's been building for decades. Japan didn't just raise rates. It pulled the first brick out of the wall. And once leverage starts collapsing, it doesn't stop because people hope it will. It stops when the system has purged enough risk. The goal isn't to predict every move. The goal is to stay solvent, to stay flexible, to not be forced into bad decisions at the worst possible moment. Because when this phase ends, and it will, opportunities will be everywhere, but only for those who still have capital. This is why I keep saying, don't chase hype, don't ignore math, and don't assume this time is different. If you found this breakdown useful, stay tuned. Because in the next video, we'll talk about how central banks respond and why their response may create the next wave of instability. Until then, stay alert, stay liquid, and most importantly, don't get poor.